Continuing on, let's say fixed income, Sidney McKinnon from Cadiz Asset Management. Sidney, good morning and thank you for joining us this morning. We always have you at the Cape Town venues and it's really great to have you again. Thank you.
Thanks everybody. Great to be here this morning. Always good to be part of this PCI session. My name's Sidney McKinnon and I'm CIO of Cadiz Asset Management. We are a specialist fixed income house. So for those of us that don't know me, I'm here to talk about fixed income, and I promise I will, but I thought I've entitled my presentation, Meteor Showers and Shooting Stars. Now, there's a phenomena that happens on an annual basis. Actually, it happens every month, but at different points in the month, where we have a celestial event where the Earth orbit crosses that of a meteor or an asteroid. We had one in August this year. It was called Perseus, if I got the pronunciation right, where we got this comet called Swift-Tuttle. I think it's 109 Swift-Tuttle or Swift-Tuttle, that has got all this debris that follows the comet, and then the Earth orbit passes through it. And then what happens is you have these dust particles that, or these particles that when they enter the Earth's atmosphere, they start burning up. And it actually creates quite a spectacular show. I put up a slide. So this is what it looks like. But you've got to find the dark corner in the world somewhere, hopefully in the northern hemisphere, and then be prepared to sit up past midnight, and you'll see quite a spectacular show. And the reason why I'm talking about meteors and shooting stars, because it made me think that our fixed income environment's not dissimilar. Because with all of these events, like meteor showers, even though it's chaotic and it's quite beautiful, but there's a measure of predictability in it. Actually, there is every month we've got almost every month of the year we've got a meteor shower. The most spectacular one is in August. We know it's going to happen. We do have the predictability. We know as I said, if you can find a dark corner in the world and watch this thing happen, it's quite spectacular, and it happens in August every year. We know that. Similarly, our bond market, we know we get coupons from our bonds. We know when it's going to happen. Every month, well, every 6 months, generally, you get a coupon from our government bonds. So, just going back, even in uncertainty, there are patterns that we can rely on. You know you're going to get your bond coupons at a particular point in time. The trick is, you know that the coupons are there, but you don't know what the returns are going to be. You can't exactly say, and I know Nola's been saying, yeah, stick with the bonds, we're going to be getting great returns, but if anybody can tell me exactly what returns you're going to be getting, then I think we can all just kind of switch off and go and play golf and make lots of money. We have to manage those unknowns. And those unknowns are defined by the conditions that surround the fixed income markets or markets in general. So, like with the meteor showers, if the conditions are right, it's nice and dark and it's a clear night, you can get quite a spectacular show. But if there's lots of city lighting, you're not going to see much. So, what conditions are prevailing in our markets at the moment? And I'm going to go through a few from the international side. And forgive me and indulge me, because I know a lot's been put up on these screens already that we've seen. I'll give you my take on it, and just to sketch what those conditions are at the moment. And the first one from an international perspective is, of course, global growth. And a lot has been spoken about global growth this morning, but we know that it's been resilient, but now we have all these policy changes coming into effect, and that's going to be quite challenging going forward, especially with the tariffs we've seen, and then, of course, the drop-off in U.S. consumer confidence. So the global outlook is becoming increasingly challenging. And what does this mean for fixed income assets, especially from a global perspective? Theoretically, this keeps a lid on yields, lower growth. And I think Nolan mentioned that early on, we've got this sort of tension between growth on one hand, and then, of course, inflation on the other hand, because inflation's ticking up slightly, but I'll chat about inflation in a second. Actually, it's my next slide, so let me talk about it now. So we've got inflationary pressures that have resurfaced in some economies, and there's expectation for it to potentially move higher as well. Why? I think the first thing is that it's mathematical. We're coming off a low base, so everybody looks at inflation on a year-on-year basis, and so naturally it's going to tick up. But there is some inflationary pressures, and we've seen some goods inflation numbers that are rising as well. And then, of course, the uncertainty as far as tariffs is concerned and what effect that's going to have on inflation is still unknown, and I think that's going to take a little bit of time for that to move through. What does that mean for bond yields, especially the US bond yields? Because embedded in bond yields is expected inflation, so that's going to put a bit of upward pressure on your bond yields. The third condition to watch our meteor showers show is monetary policy. So we've had the Fed last night cut by 25 basis points. But I think it's a lot more complicated now, not only because of just the structural framework and the data that is coming through, but because of the almost political noise that's surrounding monetary policy at the moment. I think Nolan also mentioned, and previous speakers have mentioned, those governors that are now part of that enclave and who they represent and what their thoughts are. So monetary policy across the world becomes very, very complicated in terms of what central banks are going to do to use monetary policy as a tool. If we remember, monetary policy is there as a tool to control or to influence the activity within an economy. And that's what you're trying to do with monetary policy. So, policy rate reductions can continue in certain economies where inflation is projected to moderate. But I think we're in for quite a complicated session as to how long it's going to take, how long it's going to be applied, even though the feeling is that there will be rate cuts coming through, and I'll speak about our local environment in a second. So we got this from a global perspective, and I'm only sketching 3 conditions that's clouding the night sky for us to watch the show. That's your global growth, your inflation, and monetary policy. And I think you got to find that dark corner to see the nice meteor show is becoming increasingly difficult from a global perspective. From a local perspective, I don't have to tell you, we all know the story as far as growth is concerned. We've got subdued growth. We have growth projections, forecasts that have been revised down by all kinds of parties, including our Reserve Bank, and then we've got the global trade tensions, and then, of course, low inflation, but we've still got high unemployment, low business confidence that is adding to local growth. Also keeping rates down. And for the bond market, it's not a bad thing because you're getting capital gain when rates are coming. You're getting your coupon, predictability, and if rates are being kept down, you're actually getting that nice gain. And Nolan showed a nice slide about where you can actually get that gain in the bond markets. And then, of course, local inflation. My slide's a little bit out of date. This is from July, where the family braai had become a bit more expensive. While food prices, I saw the latest numbers, that's moderated a little bit, so maybe for Braai Day on the 24th, I think it is, it will be a little bit cheaper to have your braai than it was a month or 2 ago. But we've had utility rate increases, watch out for food prices, and then, of course, but we are coming off that low base, so don't be fooled by the mathematics. It just means that you're coming off a low base, and therefore there's a bit of pressure on year-on-year inflation. But the SARB is talking about this 3% inflation preference in terms of the target. So I think there's a real commitment by the SARB to actually target low inflation, which they've been unashamedly prepared to say that is what they're trying to do, and which goes on to the next point, which is local monetary policy. SARB's unashamedly said, look, we're targeting lower inflation. We prefer lower inflation. I know there was a bit of a spat between the Treasury and the SARB in terms of the way in which that gets portrayed to the media, but hopefully they found each other now and they can kiss and make up. But the SARB has lowered its growth forecast. And if there is further rate cuts and there's higher inflation coming through, it's going to be a bit challenging. But if we get a rate cut today, I think that's positive for our market. And I think we as a house, we are leaning towards, we took a poll in our business yesterday, and we are leaning towards a rate cut this afternoon, but That remains to be seen. But that so there's this condition from a global perspective, and then from a local perspective, low growth, keeping rates down, inflation with a bit of pressures, maybe from food and core, which gives a bit of upward impetus to yields. And then, of course, monetary policy, which inevitably looks like it's going to be trending downwards, which will also keep rates lower. So good for the bond market. There's a little culprit that, not so little, that tends to influence our market. From our perspective, when we look at the interest rate environment, I've only sketched some of the conditions that's clouding the night sky in terms of the show that we can see. But there are many, many factors that drive our bond markets or our fixed income markets. And people tend to have hot buttons, right? It's the US, it is tariffs, it is inflation, it's monetary policy, whatever the case may be. But our rand tends to have quite an influencing to be quite an influencing factor when it comes to our interest rate environment. And I've listed these things all thanks to ABSA, and a lot of it's political as well, up until the point where Trump implements his tariffs, and I suppose I could enter one or two more. So there will be volatility in our currency as well, which tends to translate into our bond market as well. It's not all doom and gloom and volatility, because I think if you look at our market carefully, there are extraordinary events that happen that you can take advantage of. They do occur. And thanks, Nolan, that was a great slide. I think you actually put a lot of those events on there, which was inflation-linked bonds. It was the fact that you could get credit spreads narrowing. If you were buying the banks a couple of years ago, you could get decent credit spreads. Unfortunately, that has dissipated now, and yes, I agree with you. We have to become quite innovative in the way in which we can extract value out of this market. But extraordinary events do occur. It's for us as managers to be able to spot them and take advantage of them. So, most certainly, some of the funds that we manage at Cadiz, we've managed to take advantage of that narrowing of the spread. That's just one, because what happens is, if occasionally you get these fireballs from the meteor showers, which is quite big, but they don't last forever. They tend to burn up quite quickly, but it's very spectacular. So if you can take advantage of that, that's great. I think it's important that all good and well to spot all these factors that are influencing the market, but you have to position yourself. You need to be able to say, look, okay, so how do I want to prepare and position for what is coming? How am I going to be positioned along the yield curve? All bond fund managers love this thing called the yield curve. But it really comes down to that at the end of the day. What am I actually going to be purchasing? What am I going to be buying? What am I going to be selling? And is it really the case now that I should be maybe shortening duration because of the inflation trend and buying, or because of the growth trend and buying shorter dated bonds with a high current yield, so I get or should I be lengthening duration to take advantage of a lot of the factors that have been mentioned this morning in terms of lower monetary policy, low growth environments, and I'd like to show you what we are doing at this point in time as Cadiz. And this is just a chart which depicts our conviction, because it's good and well for me to stand up here and talk about all these great things that one should look at, but we need to make it real. We need to filter that down to our portfolios and actually implement that in our portfolios. And as bond managers, we like to say, I'm long or I'm short. What the heck does that mean? It means that you're changing the sensitivity of your portfolio to take advantage of the directional movement of interest rates. And for a while now, we've been in a long position, thank goodness for that, which has served our portfolios quite well. But it's no coincidence. This is a result of our investment process that is very comprehensive, that takes all the factors, and I've shared with you a few of those factors this morning, that influence the directional movement of interest rates, and we're still in that position to take advantage of the downward trend. So A little bit of marketing. You can see that in our funds, in this fixed income space. In the multi-asset space, we've got an enhanced income fund, which is quite sizable inside a Reg 28 compliant, and it uses credit, uses those fireballs, it uses it very well. We're looking for other opportunities at this point in time, and it uses a big diversification strategy, but we can, if you have, I challenge you to go and have a look at the returns and the way in which this fund has actually performed on a risk-adjusted basis and achieved its objectives consistently over time. We do have an absolute yield fund as well that uses asset allocation because you can use credit and you can use diversification, but you must be able to pick the right assets. So whether you're buying bonds, nominal bonds, inflation-linked bonds, or floating rate notes, this fund takes advantage of that, and similarly matched to our investment, overall arching investment process, it's delivered the goods. So, like meteor showers, the fixed income rewards those, or the fixed income environment rewards those who are patient, prepared, and positioned. I didn't realize that's 3 P's, but okay, patient, prepared, and positioned for the right environment. You'll be able to see a spectacular show. So that all remains for me to say is thank you. And for my colleague at the back of the room in Tsonga, let me get this right, I hope Nzakenza will help me put this presentation together. Thank you.